You're watching Your Money Matters here at NDTV Profit. I'm Mahima Vachrajani, and we're going to throw light on two important topics today, as we do always on every show of Your Money Matters. The first one that we're going to talk about is with regards to SWP. For most investors, focus is always on building wealth. But the real test of financial plan generally begins when you start withdrawing from it, right? So how do you take money out, and can be just, could be just as important as how you invest it. And that's where systematic withdrawal plan comes into picture, because it's often seen as a retirement tool. But there's much more to that. Especially when it comes to the tax angle, tax efficiency, cash flow planning, etc. And to discuss exactly this, today we are joined by Nisreen Mamaji, who's a CFP and founder of MoneyWorks Financial Services, joining us now. Nisreen, thank you so much for taking out the time. Always a pleasure speaking with you. My first question to you is that most investors think of mutual fund as an accumulation tool, right? And SWP is a flip of that, completely opposite of what an SIP is. In what life situation does SWP actually work better than the traditional dividend or lump sum withdrawal approach that generally people take up?
Sure. So, firstly, let me start by thanking you for having me on the show. It's a very interesting concept, basically, and investors are very much interested in knowing how SWP works, which is a systematic withdrawal plan for mutual funds. Now, basically, what we try to do is, it creates regular income, like a pension for retirees. It can also fund a specific goal, like if you have an EMI, you have an education goal, you can time your withdrawal for that as well. It can also provide you a supplementary cash flow and create a very disciplined way for you to take out the profits from your investment and keep your principal intact. So this way, you will get tax efficiency and control over the withdrawals, exactly when you need it and how much you need. It's ideal for anyone who's looking at, creating a steady payout system without liquidating their entire investment. And also it can work as a, self-created pension also, or a steady income stream. So there are many benefits of an SWP. Like when you're retired, you can have a monthly cash flow. You can replace your salary income with a predictable income. And you can also avoid annuitizing large sums early on, which can have tax implications and, can upset the entire cash flow management, because you aren't deploying a larger sum. Like when you get your gratuity, you get your PF, you get your superannuation, you get all those large amounts. But if you've just parked it in, say, a simple thing like a savings account or in a bank FD, then you're not, using that money very efficiently. You can also, use this for market volatility. Basically, what happens is that, you can avoid timing the market. Like sometimes we withdraw a lump sum, and that may not be ideal from the market point of view. But if you're withdrawing a steady amount over the entire year, you're avoiding the mechanism of market timing, whereby you have to select the best day and time. So that, because of the discipline of SWP, that action is taken away from you. You can reduce the risk of redeeming only during market lows and market highs, because this will create a volatility and give you an average pricing when you're withdrawing, and can also smoothen your cash flow during volatile phases. Also, you can have education. So the reasons that you would do an SWP is education expenses can be spread over the years, because sometimes you have to pay tuition fees, every 3 months, every 6 months. So accordingly, you can withdraw from the corpus and not all at one time and, leave it lying inefficiently in your savings account. Suppose you are trying to start a business, okay? So like for an entrepreneur, you will also have regular cash flow requirements during the year. So there again, you might have saved some money that you intend to, have a startup. So as an entrepreneur, also you can use an SWP and withdraw the funds, pay for your rent, pay for your utilities, pay for your salaries. So like, you have a fixed expense on, between the 1st and 10th of every month. You can time your withdrawals accordingly.
So Nisreen, then somebody who's living off their portfolio income, right? What would your advice be, to such an investor, and how does he or she decide how safe withdrawal looks like, right? Because I'm not sure if there's a thumb rule in place, but what does the ideal situation look like?
So, see, typically what we do is, when you have a corpus, and you are going to withdraw for the say maybe next 10 to 15 years. So a laddering system is created whereby say the first 3 years instrument money that you need, your actual payouts are invested in say an arbitrage fund, an equity savings fund with very less of equities, a balanced advantage category. So any dynamically managed hybrid category where the equity allocations are low and you have a lot of arbitrage on say fixed income or debt. So that way that amount of corpus is not exposed to too much volatility by managing the equity levels. So in that sense, you can keep the safety component as you have asked for specifically. And then anything above, in the 3 to 5 year bucket can be invested perhaps again in dynamic asset allocation funds, or maybe if you're going in for 100% equity funds, the larger cap space again to manage the volatility. And anything in the 5 to 7 year bucket or longer, you can have a series of investments from which you will be able to withdraw. At the same time, you know that the corpus is growing at a certain rate. So the systematic withdrawal plans in that sense, by the laddering system and in terms of how you have invested, you can manage to keep it safe as well as you can manage to keep the withdrawals fixed. You don't want to at any time run out of the money in any particular month. So the volatility has to be managed and the risk has to be managed. So this is one of the ways where you kind of spread the risk and spread the investment over various kind of funds and manage the volatility. So that's one of the ways that you can keep the safety component intact.
Okay. All right. So, Nisreen, then how should SWP structured? Because we've seen as to how 2025 was a volatile year for the markets. Consolidation, of course, happening, but with regards to where the broader end of spectrum was concerned, it was volatile to say the least, right? So, how does one structure that, considering the volatility in the markets is here to stay?
Yeah, so that's exactly what I mentioned earlier, is that you have a laddering system.
Okay.
And the first few years, you maintain it in mutual funds which have very minimal equity allocation, or maybe, even have zero equity allocation. So there are hybrid funds, there are dynamically asset funds, there are regular savings funds, there are ultra short funds, there are arbitrage funds. So your first few years can be, in any kind of an instrument where you are not exposed to the volatility that, we have seen recently in our recent past as well. And money which is there for the longer term can be exposed to higher equity allocation and also, higher volatility. But if you spend the requisite number of years in an equity instrument, then, you are able to have a corpus which can afford and which can sustain the withdrawals later. So in this kind of a case, the FIFO concept comes in, which is first in, first out. In a mutual funds, what it means is that the units which were purchased earlier uh, and then you withdraw that. Like suppose, as I mentioned earlier, you've invested in equity savings fund for say the withdrawals of the first year. And for the withdrawals of the 10th year, I invested say in 100% large cap fund. So the large cap category has been invested for the last 10 years and you have not started withdrawing from there at all. And what you're withdrawing from year 1 and 2 is the one that will go into first in, first out. So FIFO in accounting means that when you redeem mutual funds, whatever you have invested in the first year and you have redeemed it, that will be considered for taxation purposes. This has a very good effect also for tax, because sometimes what happens is that what you have invested first year has already finished, say in equities, 12 months of investment, and you have started withdrawing post that. So automatically your long-term capital gains will be 12.5%. And your short-term capital gains is at the rate of 20% for equity funds. So for example, suppose you have invested, say you have purchased units at 10 rupees and you have withdrawn in year 2 at 15 rupees and year 3 at 25 rupees. But the cost of the original purchase is 10 rupees. So your capital gains for 15 rupees, when you're selling at 15 rupees, is only 5 rupees. And your capital gains of what you have sold at 25 rupees will be 15 rupees. So in year 1, you're only paying capital gains on the 5 rupees appreciation because you have bought units only at that particular rate. So in that sense, capital gains can be greatly affected and there will be a lot of tax efficiencies by the first in, first out concept.
Understood. Nisreen, one last question. If, because you would have come across this, like there would be certain mistakes that investors always make while doing SWP. What is that one mistake that, generally happens, and what could you do to avoid it?
So basically, I think the calculation is very important that, you should be able to know what is the amount that you actually need, for your SWP. So what would be very interesting also is that you have calculated your withdrawals and you have factored in inflation. Sometimes our investors, do not factor the inflation. So what they have withdrawn in year one, they are withdrawing the same amount in year five. And thereby, they face a lot of challenges because in the last 5 years, prices of, normal home running items has gone up. And then they face a cash crunch. So sometimes the corpus is enough to sustain them with an inflation adjusted systematic withdrawal plan, but that is not factored in by the investor, and that it makes a lot of sense for you to plan your withdrawals factoring inflation. So even if you're doing the calculation upfront, like today, what will I need for a withdrawal, say 15 years later, the inflation concept should be factored in. Otherwise, your calculation goes for a toss. And you are then withdrawing an amount which is not enough to sustain,
Right.
say, a retiree or even your EMI or your education goals. So any of the goals that you could be funding.
Okay, all right, Nisreen. I'm sure that our viewers have understood what SWP means and what it means in terms of taxation as well in detail. So thank you so much for giving us those insights and, of course, taking out the time and speaking with us at NDTV Profit.